Central banks have shaped market sentiment this year, with the US Federal Reserve raising rates just the once, the ECB extending their stimulus program, the Bank of Japan desperately trying to ignite inflation, and the Bank of England also cutting rates. So what will these masters of the universe do in 2017? Well, Marc Ostwald from ADM Investor Services International joins me now. As I say, masters of the universe, they've kind of manipulated the markets. We've been on edge every time there's a meeting. What do you think was the biggest event? Was it the Fed?
I think actually probably the Bank of Japan. Let's give them some credit here. The Bank of Japan's move to start yield curve control has been one of the key factors outside of Donald Trump's election victory and the Brexit referendum in changing the way things, particularly the currency markets, operated. What we've seen, particularly of late, is that sharp weakness in the yen is effectively about the Bank of Japan's yield curve control, because effectively what the Bank of Japan did when it said we're targeting 0% on 10-year yields is, if you want to take a view on Japan, then you're going to have to do it via the currency markets. And so far, their mission looks to have been very, very successful. The yen has fallen very sharply, and that, in theory at least, should help them, along with the rise in oil prices, to see them get their CPI target a lot. There's a much higher chance of them getting to it than, say, when we were just meandering around between 100 and 105.
But the Fed, though, I mean, I know it only moved the once, but really, in terms of market attention, it commands the most, right?
The Fed move, one has to say, well, yes, insofar as people were surprised that they said three rate hikes next year when they were expecting them to say two. That said, the market's still very, very sceptical, as it was at the end of last year when they were saying 3-4.
Well, exactly. I was going to say that this time last year we thought we were getting the 3, the 4. Well, we didn't. We got 1. Yeah. So actually, can we even take this dot plot seriously?
Well, I think what one always has to remember is this is not a forecast. This is just various people's view of what they think, or this is on the FOMC, of what they think the appropriate rate path would be. It's not a forecast, it's just how they see things at the moment. And eminently, you've got a huge amount of divergence, and actually one of the biggest contributors to the third rate hike being included is the fact that Mr. Bullard, who's been very maverick, he basically, at the middle of the year, decided we only need 1 rate hike over the next 3 years, and he moved to saying we're going to have 2, which really still is somewhere out on blue 6 relative to the rest of the committee.
Let's talk about the Bank of England, because the governor, Mark Carney, he got a lot of criticism for cutting rates when he did. That was in reaction to the Brexit vote. A lot of people said it was premature, and now he's not left a lot of room to manoeuvre.
I think he was premature. I think he will always nevertheless claim that the relatively soft landing, if there has been a soft landing at all for the UK economy post the Brexit referendum, was down to the Bank of England taking preemptive action. That is, you can't actually argue with him saying that, but it's still highly contentious. I would argue that actually the impact of the Brexit referendum, particularly once we start to get the Article 50 triggered, will first be felt in the economy in a significant way more in the second half of next year. And that's where this point about them not actually having a lot of ammunition left in the locker may come home to roost. It's also going to be interesting to see how the gilt market, after the beginning of February, when the current round of gilt QE comes to an end, how the gilt market survives. It's already seen 10-year yields triple effectively relative to when it first started. So they're in one of the more uncertain spots because they could go either way depending on what happens with inflation. And a lot of that will depend on what happens with the pound, which will be very sensitive to all the Brexit news.
So the ECB, though, is going to continue with this stimulus programme as expected. Is it the right move, or do you see some pitfalls ahead, some dangers?
Their problem is if oil prices stay at this sort of elevated level, if we lose some more ground on euro dollar, it would have to be quite significant. So we'd have to be talking well below 1 against the dollar, so somewhere down in the low 90s to really have much of an impact on inflation. Then inflation may well take off and start to head towards 1.5, 2. And then we have to start wondering whether the hawks at the ECB will become that much more vociferous. Because as much as Mr. Draghi said, oh, it was a unanimous decision, no one was talking about asking for tapering. You've then got comments from the likes of Mr. Weidmann, who said that I didn't approve of the programme at all. You've got the Estonian Central Bank Governor, Mr. Hansen, saying, thank goodness we've got a slower pace of QE. So clearly he wasn't, shall we say, quite telling the truth on that front. And it will be the tensions within there, obviously in the context of what goes on politically next year. Now, there are plenty of people who would argue that they extended for the 9 months, not primarily to readjust from 80 to 60 and then sort of add that into the end of the year, but because they really just didn't want to get involved in any of the political risks next year. We know we've got French, Dutch and German elections. We're likely to have Italian elections. We could well have Greek elections, and the ECB just wants to be able to carry on in its own sweet way without anyone making any particular demands on it.
Okay, Marc Ostwald, thank you very much indeed. Talking to us today about central bankers and all what we can expect from them in 2017.